This show is going to be dedicated to really digging deeper into the headlines. And so we're going to talk a bit about tariffs. We're going to talk a bit about Social Security. We're going to talk a bit about taxes. We're going to really try and dig into all of this. If you are a client of Nelson Financial Planning, some of what you may hear this morning is what you heard this past week at one of our regular client educational events. Those are events that we hold for our clients every quarter. And of course, this quarter, or this last one, was a big one because, let's face it, there's been a lot of headlines over the course of the past 30 days. Had what I think is probably a record turnout of well in excess of a couple of hundred folks for dinner at the Country Club of Orlando, which is where we host those. They've got a great little format, great little ballroom, a couple of drop-down screens, in a fireside chat format between myself and a senior executive at a major investment management company. And so we dug into it. And I said, when I sent out the reminder on this past Monday to our clients, hey, this one's going to be full. So get there early and be ready to kind of have a full conversation. So I went for about an hour and 15 minutes on the presentation alone, and then another probably 20-ish minutes on the Q&A. But one of the biggest reasons why we do those events at Nelson Financial Planning, and we've done them for years, for at least, I think back when Jack started the company in 1984, we were doing some of those. When I joined in 1999, we were doing them all kind of at the beginning of the year. So one of the things that we kind of changed was to divide them up throughout the year, because they really do serve a pretty important purpose of really helping to educate and helping to provide perspective beyond what these headlines are. So that's the purpose of this week's program here on Dollars and Cents, where we help you make sense out of all of life's headlines, including the current headlines. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. If you think we can be of help to you, go check us out on our website at nelsonfinancialplanning.com. All of our conversations are absolutely free of charge. So we'll start with tariffs, and we're going to talk a little bit about what a tariff is, right? And some of the functions that it ultimately serves. So at the end of the day, a tariff is essentially a tax on a good that is imported from another country. They're used to help protect domestic producers, right? So if we're bringing in a product from another country and we put a tariff on top of it, then that makes that product a little bit more expensive. And in doing so, it in theory helps to protect a domestic producer of a similar product, because the domestic producer then would not be subject to that tariff. So tariffs can ultimately serve any one of four sort of different motivations or fundamentals behind what a tariff is set out to accomplish. First is the notion of decoupling, which basically means that it helps to shift supply chains and ultimately reduce reliance on certain countries. So you hear a lot of that kind of, we want to be less reliant on other countries. So that's certainly part of the current conversation about tariffs, is that decoupling notion. Rebalancing is another sort of different purpose, if you will, of tariffs. That helps to reduce trade deficits and boost domestic production. If you haven't checked our trade deficit lately, it's a really big number, like over $1 trillion. So that might be something worth talking about, or at least focusing on. Negotiating is another purpose of tariffs, and that obviously helps to use economic pressure, right, to help to achieve certain policy outcomes. And then lastly is the funding aspect of tariffs, where you can use that money to help generate revenue to fund budget priorities. Interestingly, before World War I, that was kind of what this country was based on in terms of where it got its funding from. It was all tariffs prior to that period of time, and then it flipped to an income tax system. Now, two sides of every equation, right? And I assure you the tariff is a kaleidoscope of issues that are extremely complicated in terms of how it all interacts. We've got one side that is talking about tariffs starting a new trade war that ultimately nobody wins because it's just, oh, I'm going to put 10%. You're going to put 10%, I'm going to put 15. You're putting 50, I'm putting 20. You see how that can kind of rapidly escalate. And then at the end of the day, it certainly has an inflationary pressure, right? Because if costs are going up, then things cost more. That's called inflation. On the flip side, of course, is you have the folks that are saying, well, these tariffs, it's an attempt by the U.S. to reduce some of these long-term trade deficits and compel other countries to lower their own protectionist measures. So in either case, it certainly does reflect a shift in sort of the geopolitical world order that probably is just beginning. Tariffs at the end of the day certainly can reshape supply chains. They can alter competitive dynamics for different businesses and sectors and certainly influence international trade patterns. So that's kind of the background on kind of the tariffs. Let's take a look at some of these numbers and sort of talk through the current climate. And I think this is the part that is kind of interesting to help bring some perspective into the current headlines. So current trade deficit, $1.1 trillion. That's real money when you stop and think about that. We buy way too much junk, and put it nicely, and sort of need to figure out a way to level the playing field, if you will. U.S. has been running a trade deficit every year since basically the 1970s. And then the other issue that is real is there is a competition issue here. Lots of countries are and have been imposing tariffs on U.S. goods coming into their countries for some time. Just easy example is on a car. And, car, that's a pretty big ticket item, right? I mean, it's one of the bigger ticket items that you'll purchase during the course of any given year. And when you think about Europe's tariffs on our cars, so think like the Ford coming into Europe, okay, tariff there is typically like 10%. Now, a European car coming into the U.S., the tariff is 2.5% as it stands now. So the tariff that our car is getting charged to sell in Europe is actually 4 times greater than what we're charging for their cars to come into our country. So doesn't that seem a little unfair? So, look, we understand the messenger at the heart of this is not some cuddly-wuddly bear that can, explain the nuances in a kind and gentle way. I wonder if this, if this was Clinton or Bush or something like that maybe the messaging might not be, as I guess, difficult. It might be a little bit more nuanced, right? But this is not necessarily revolutionary thinking of what we're seeing here. These are not, made up issues. These are real issues. When you start to think about tariffs and the impact of tariffs and what that is on our goods going into other countries, and kind of how all of that plays out, I certainly think it would be nice if the message was maybe a little bit more nuanced or maybe a little bit more explained, I guess, might be the issue. But the reality is that, those are the numbers. That's how all of this kind of plays out. Let's not forget about VAT taxes as well, by the way. A lot of countries put those on production along the way. And if you kind of think of that from a European perspective, that might be a little bit more. So we're going to take a break there and continue here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So talking a little bit about tariffs and kind of looking at some of these numbers that we're talking about, and we think about the trade deficit, 1.1 trillion. That is a real number, and we think about tariffs and what tariffs are imposed on U.S. products abroad. That's a real number. When you think about cars going to Europe from here that face a 10% tariff, whereby cars going from Europe to here face a tariff of 2.5% currently. So there is something to talk about here, and maybe the messaging could stand to be a little bit more nuanced, and we can certainly all debate that, but we're not here to debate politics. We're really trying to talk through what the implications are of these tariffs, because tariffs serve a variety of purposes and have always served a variety of purposes throughout history. Remember, before World War I, we didn't have an income tax system. We had a tariff system. So just a little perspective, I think, goes a long ways. And if you look at some of the VAT tax stuff, the value-added tax stuff that many countries apply on production along the way, in the case of the EU, if you take the VAT tax into account, actually sort of implies a much larger tariff of about 25%. So a little perspective, I guess, on it. Certainly in the short term, tariffs can be inflationary. There's no question about that. There's not really a whole lot of debate there. But how it actually plays out over time, and I guess that's the point, and one of the things that we're going to be talking about on the program is that how it plays out over time, I think it's a little bit more complex. More often than not, that cost is divided between consumers and businesses. Consumers, obviously, in the form of higher prices, but businesses in the form of sort of lower profit margins. So I think at the end of the day, the tariff conversation is certainly not a easy to follow or easy to understand issue. The important thing to remember, though, is that you do have to have some conversations about this one. It's way too big of a trade deficit. There are protectionist measures that many countries are imposing on U.S. companies that are simply not creating a level playing field for our U.S. companies to compete abroad. So a longer-term issue, if you will, that is certainly changing some things up. Some things good, some things bad. And right now, of course, the markets are trying to figure out all of that, right? That has led to certainly a much greater increase in volatility, but volatility passes. The important thing to always remember in periods of time like this, so the bottom line here really is, your investments should always be focusing on sustainable companies, businesses that have sustainable competitive advantages, if you will, and diversifying across different geographies and sectors that ultimately are going to have varying tariff sensitivity. The impact of tariffs can certainly dramatically differ between different sectors of the economy, with some industries facing more challenges and while others seeing more of an opportunity as it relates to this. Even on a company level, the impact can vary. So, might have more a company with more flexible supply chain, or perhaps a product that isn't going to be as subject to tariffs, like maybe cloud computing. Those are where some opportunities are. And along that same lines, you would also see certain competitive advantages for domestic-focused companies, right? So if I'm a company that generates most of my revenue here in the U.S., then the tariff thing isn't really that big of an issue per se. So that would be businesses in banking or utilities or financial services or even healthcare sort of come to mind. Beyond that, international side of things is another option that it certainly is showing some opportunity, particularly for those countries that maybe aren't directly involved in being the target of some of this trade and tariff stuff. We see that in places like Vietnam and Thailand have obviously benefited greatly from various supply chains moving out of China. So market's clearly trying to figure out all this, right? A lot of volatility, from a historical perspective. Week before this past one, you saw a market correction, which for those of you who aren't familiar with what that term is, the technical definition of is a market correction is a 10% decline from a prior peak that occurs in the market. So as of week before last, the S&P 500 had sort of checked the box, if you will, on that market correction and had declined 10% from its record peak on February the 19th and went through that decline of 10%. It actually happened within 16 trading days. And you may say, wow, that's really quick. That has to be some kind of a record because that was, 16 trading days. That's, a little over 3 weeks. That actually doesn't even put it in the top 10 of market corrections in terms of speed of market corrections over the course of the past 50 years. Came in at number 11 with that happening in 16 trading days. So for perspective, I've been doing this for 26 years and, I've seen 13 different corrections. Had to ask AI on that one because, I'd kind of forgotten some of them along the way, which is sort of in line with the historical average. When we think about the historical averages, you do see those periods of time where the market shifts, usually, 10% market correction, as the definition is, occurs once every couple of years or so. So that would, I've been doing this for, 26 years. And so to see 13, that's kind of hits the average, if you will. Bottom line, they are never fun to go through. But at the end of the day, they do pass. And those periods of decline are much shorter than those periods of expansion. So remember that when you're thinking about your investments. Continuing on, and if you missed the beginning part of the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, we're talking about some of the topics that our clients at Nelson Financial Planning were able to hear this past week at one of our quarterly educational events. As we said, it was going to be a full event, and it really did wind up being a full event, our largest crowd and probably our lengthiest time speaking about all of these different topics. And we thought it timely enough that we wanted to share a lot of that here on the program with you this week with sort of our radio and podcast listening audience. So that's kind of what we're sort of plowing through, if you will. Just finished sort of the conversation about tariffs and sort of the impact and some perspective on that, and then correlating that with some of the recent market volatility that we've seen. We will, shift a little bit and talk a little bit about taxes. This, of course, is tax season. You got about 30 days left to get your taxes done and complete. And the tax conversation is one that has not yet hit full stride. They've got a lot of other things that they're trying to hit full stride with at this point. But the tax conversation is going to be a very important one, and one that you will absolutely hear a lot about, because all of these tax rates expire at the end of this year, here at the end of 2025. Let's face it, that is sort of the signature item for the first Trump administration, and they certainly do not want to have that not be able to continue. So those tax cuts are all set up to expire at the end of this year. Obviously, they're going to be looking at ways to help to adjust and shift what those tax rates are going to be and continue them going forward. But I guess the perspective on all of this, and this is one of the things that we were talking about this past week at our client educational event. I mean, I think too often the media is describing a lot of these conversations as somewhat sort of out of the box or revolutionary thinking, or kind of however you want to describe it. And the reality is that, these conversations, whether they are about tariffs or corrections or even taxes, there's a lot of historical precedent for kind of what we're talking about here. And when we think about some of these headlines and how it relates back to what ultimately is being talked about today, it's an interesting perspective. And so we're going to share one of those perspectives when we return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we are really digging into the headlines on this week's episode of Dollars and Cents and kind of going through a lot of what we shared with our clients this past week in terms of our most recent quarterly educational event. It was a full event because there is a lot of headlines that we need to digest. So we started the program, much as we did that educational event this past week, with a conversation about tariffs. And then we talked a little bit more about market corrections and the historical perspective on them. And then we started to talk a little bit about taxes and what all of that might mean for this year as we go forward. And I want to talk a little bit, and I think there's a perception issue a little bit out there. And I get it, as I've been kind of said a couple of times on the program, look, Trump is not some cuddly wuddly teddy bear that is very nuanced in how he communicates to the media. It's not what you got there. Okay. And I think that is impacting the ability to really kind of understand what's behind some of these conversations. And I'm going to use the example of Social Security and the taxation or the tax-free to sort of underscore what it is that I'm trying to communicate, because you heard a lot of conversation, particularly on the campaign trail, about making Social Security tax free. And the concept is not as a revolutionary as you think, particularly when you look at the history of the taxation of Social Security. So Social Security used to not be taxable. Okay. And at the time, during the course of our educational event, we did a little instant snap poll, show of hands is kind of how we did it. It wasn't like on the internet or on your phone or anything like that. It was just a simple show of hands like you used to do polls by. Anyway, we asked the crowd, do you think it was a Democratic president who caused your Social Security to be taxable, or do you think it was a Republican president who caused your Social Security to be taxable? And you can fill in the blank as to which way you think that poll went, but I will tell you the answer. It was a Republican president, none other by the name of Ronald Reagan, who caused your Social Security to be taxable. The year was 1983, and the legislation passed. He signed it into law that effective in 1984, your Social Security was now subject to a means testing threshold. And what means testing basically means is that the more money you make, the more means you have, okay, well, then the more you're going to have to pay tax on certain sources of income. Well, in the case of Social Security in 1983, they set those levels at $25,000 for a single person, $32,000 for a married couple. Okay. But what they didn't do is they never indexed those thresholds for inflation. And I'll tell you, if you know anything about the tax code, you know that those inflation adjustments are throughout the tax code. Every year your standard deduction changes. It goes up based on what inflation is. Every year the income tax brackets expand and shift, again, based on inflation. Every year you contribute, the amount that you contribute to your IRA goes up, again, based on inflation and depending upon what the next dollar level is. So some years you'll see it go up, but every couple of years it'll go up, right? They didn't do that with the threshold for Social Security. So here's what the problem is. More and more Americans are finding that their Social Security is taxable, not just taxable a little bit, but fully taxable up to the full 85% of the amount that they're getting on Social Security. So we talk about the taxation of Social Security and whether it should be tax-free. That is not a revolutionary concept. That is a concept that was true in its entirety prior to 1983, and going forward, it was only supposed to apply to a certain group of Americans who had higher levels of income. Now, fast forward 40 years, and what do you think is happening to the thresholds that were never indexed for inflation? It's getting more and more people, and pretty much now everybody's paying tax on their Social Security. How do you fix that? Well, the fix is, in my mind, you could just like inflation adjust the number. And at the end of the day, that's not a revolutionary concept. It's something that happens inside the tax code pretty much for everything else except for this. So the fix is not, again, it's not as revolutionary as you might be thinking. The reality is that it's a fix that is simply, if you use a lot of the current concepts that exist in the tax code, then you can kind of get to the point where Social Security winds up not being taxed anymore, or tax-free, if you want to use that, exciting term. Then more Americans are going to find that their Social Security is tax-free. Just so you understand the comparison numbers, if you had put an inflation rider on those $25,000 and $32,000 numbers, the $25,000 would have projected to be about $55,000, $60,000 today, and the $32,000 number would be about $70,000, maybe even $75,000. So stop and think about the impact and how much more people that sort of excludes from the taxation of Social Security. So, golly, there's just so many layers to all of this when you start to kind of dig into it. And I think the conversation about taxation of Social Security and how that plays out is just one of those kind of things that really has a lot of different layers. And the same thing can be said for Social Security as a whole, right? I mean, we've certainly of late have been fielding a lot of questions about the survival of Social Security. Is my Social Security check going to stop? And man, there's a lot of historical precedents for how you fix Social Security, and it has to deal with tax rates, but more importantly, it has to deal with ages at which you're eligible to collect Social Security. There's a ton of historical precedents for this. So when I was born, the full retirement age was 65, and then when I was the ripe old age of 13, it switched to 67. And the reason for that is because Social Security program wasn't in particularly financially good shape, so they shifted the age. So there is historical precedence for how you go about this. Remember, I was 13 when they shifted it from 65 to 67. So plenty of time to prepare for what would be that change in age. So I guess the comment that I would have there is, be careful about the messaging in the media and the internet and all that. Oh, it's going to stop. It's going to stop. No, we can't use those arguments, folks, to not engage in a conversation. We cannot put our heads in the sand on these issues because we have to have the conversation. But the second you have the conversation, someone's out there screaming, oh, they're going to cut your Social Security check. Look, that's not how it works. There's historical precedents for this. When they make changes to Social Security, they make those changes so they impact people that are 15, 20, 30 years away from ever collecting in the program, and thereby that gives them a lot of time to prepare accordingly. Because when I look around the office at Nelson Financial Planning, and I look at the Chets and the Zoes and the Nicks and the Zacks, all of which work for Nelson Financial Planning, all of whom are under 30, all of whom are paying money, 6%, 6.2% of their paycheck is going into Social Security, not including the 6.2% that Nelson Financial Planning does as their employer. The reality is, do you really want to kind of, screw them out of that? I don't think that works. So you can't just stick your head in the sand. You got to start to have these kinds of conversations along the way. So definitely an interesting time, that is for sure. We're going to take a break and continue here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So needless to say, our most recent quarterly educational event this past week for our clients at Nelson Financial Planning was a full one. We have spent the first three segments of the show just talking about the headlines, sort of chewing through tariffs, chewing through market corrections, chewing through taxes, chewing through Social Security. We're going to leave you in this last segment with some of the trends that we also talked about at that educational event for our clients at Nelson Financial Planning. Some of the trends that we see are going to be much more powerful, much more impactful for the economy, for the markets, and for your investments as we think about what the future looks like. So identified sort of a variety of trends. We're going to kind of share those with you here on the program, here on Dollars and Cents. So these trends involve things that you've been hearing about all along the way, but really do require additional insight or additional introduction, if you will, in terms of what their impact is when we think about not just this week's headlines, but over the course of the next several years, which obviously is important from an investment perspective. So we're going to talk about trends involving AI, trends involving manufacturing, trends involving healthcare, and talk about sort of each one. And I understand with AI, okay, you're probably tired of hearing about it, but get comfortable. It ain't going anywhere. And in fact, we may very well be underestimating the impact that it is going to have on society as a whole. Why do we say that? Because typically when we have these major developments, we in fact sort of underestimate what the impact is going to be. I'll give you a couple of examples. PC users in the year 2000, the initial forecast was that there would be 225 million. What it actually turned out to be is that there was 354 million, an underestimation of 36%. The internet users in the year 2000, initial forecast was 152 million, wound up being 361 million, an underestimate of 58% in terms of who wound up actually using that technology. Same thing again happened with smartphones, mobile phones. The first one shipped in 2013. Man, stop and think about that. It's 2025. That was just 12 years ago. Can you imagine life without a smartphone? Just crazy, right? The initial forecast was that there was going to be 657 million units in use, wound up being over a billion in use, so underestimation of 36%. That's been the trend with technology and how rapidly it expands. The initial estimates have been wildly underestimated. Expect the same thing to happen with AI and how much it is getting utilized by individuals and businesses and major corporations on a regular basis. And that introduction or that integration is really just starting. Number two, manufacturing. The domestic production sort of concept where you're bringing or onshoring a lot of manufacturing back into this country. The build out on that, the billions and trillions of dollars that are getting spent nationwide, and the amount of physical resources, the capital expenditures, and don't forget, all that stuff needs electricity as well. And so if you're doing electricity, well, then you've got a bunch of other things that you have to do as well. Some big trends, big longer-term trends when we think of it. And then healthcare, right? I mean, that kind of ties into the discussion about Social Security. Certainly a whole lot, right? As successful as healthcare has been, then that means that people are living longer. And if people are living longer, then you plan appropriately and maybe push out those ages of eligibility for those that are still 20 odd years away from Social Security in the first place. Not unlike what happened to me in 1983 when they changed my full retirement age from 65 to 67. But see, in 1983, that was enough years to kind of plan for it and act appropriately. What's interesting is that we put a chart up that really, we put the chart up at the educational event this past week. I could hear the audience's breath, really kind of be taken away because it's such a powerful chart. If you haven't seen it, I would encourage you to kind of get out there and look for it. The mortality rate per 100,000 people for cardiovascular disease over the past 50 years has gone from 532 down to 134. That's pretty impressive. If you think that's impressive, the mortality rate for cancer per 100,000 people in the population has gone from 141 down to 97. Pretty dramatic when you start to look at that. The top 10 pharmaceutical companies, just the top 10, have over 1,600 different drugs in the pipeline. Now, the reality is not all of them are going to make it into your local pharmacy, but a lot of them will. Stop and think about the impact that that's going to have. And along the way, past 50 years, life expectancy has gone from 68 to 79. Stop and think about that, right? So 68 was the life expectancy 50 years ago, and it's now 79. You see where we come up with those numbers and the historical precedent for how you ultimately address things like Social Security? If life expectancy has shifted that much, you kind of got to shift the age as well, right? I mean, that's an 11-year differential, but there's been no change on the ages of eligibility for Social Security for the past 40 years. Anyway. Bottom line on all of this, and you throw in international as well, because some of these conversations, some of these headlines are actually spurring or jolting, if you will, other countries to action. This past Friday, Germany passed legislation to spend an additional $1.1 trillion to help shift its economy into action and reduce its reliance on U.S. military. If you haven't sort of looked at your international funds, or maybe you've really eliminated them out of your portfolio, it might be a good time to kind of take another look because significantly better relative performance versus the U.S. markets these days. And if you think about their stock markets, trading at a relative better value, if you think about traditional measures like PE ratios, price earnings ratios, things like that, that are better or cheaper, if you will, outside this country. So all kinds of stuff that I think bottom line from an investment perspective, despite all of these headlines, there's still a lot of opportunities out there, a lot of sort of longer term opportunities out there that ultimately are predicated more on those longer term, bigger drivers of your investments and what's in today's headlines. Also this past week, Federal Reserve met and decided to stand pat. I guess the positive of that is to the extent you have cash, and there's a lot of cash out there, about $7 trillion or close to $7 trillion right now. Good news is it's still going to continue to earn a little bit of interest, so that's good. But you got to really be careful on that. Make sure you're shopping around on that. The banks have really already cut their rates in anticipation of further Fed Reserve rate cuts, but the Federal Reserve doesn't appear that it's going to be cutting anything. It's going to be kind of standing pat for now. So make sure you're checking that out and digging a little bit deeper in terms of what your cash savings is actually making. Maybe look in some money markets and things like that to earn. Make sure your cash is earning a little bit more than what you would typically get. So anyway, covered a lot of territory as we do each and every week on the show here at Dollars and Cents. This one was particularly interesting because we really did have a much, much fuller conversation. There's only 40 odd minutes here in the program, in the radio show podcast. Like I said earlier in the program, we went probably with the Q&A, we probably went close to an hour and 40 in terms of covering all of these topics, plus a bunch of other things that came up in the Q&A as well. So it's so important to be informed. That's why we do those for our clients at Nelson Financial Planning. And if you're not a client and feel like you might have missed out on getting some education and perspective, go to our website at nelsonfinancialplanning.com, and there you can schedule an absolutely free conversation with any of our certified financial fiduciaries at Nelson Financial Planning. Have a great rest of the day.